Hi, I'm Pattu from freefincal. Today let's take a look at DSP Value Fund. This is a fund that was started just a few months ago. It was started only in December 2020. It's got only an AUM of about under 500 crores at the time of writing. The reason why it has caught the attention of the investor community is because it can hold up to 35% of its assets in foreign securities, and because of that, you can see in the graphs below that its NAV has become less volatile in the last few months. They are wondering if it can be used as a substitute for the Parak Flexi Cap fund, since that has grown in AUM over the months. Now, the problem with the value-oriented funds, as we have seen in the past in the case of Quantum Long-Term Equity and ICICI Value Discovery, is that there will be a long period of poor returns where the fund will struggle to perform, and then it will suddenly perform, and then so it will be a cyclic sort of thing with these funds. We will talk about that more in future, about the cyclic nature of value investing indices and funds and so on. So you'll have to be ready if you are interested in investing in this fund. You'll have to be ready for this kind of a performance. Now, the point is that if you look at the performance of this fund since inception with respect to the Nifty, the Nifty is in brown, the fund is in white. You can see that the fund has been significantly less volatile and moving up, and you can see this portion. This is when the foreign securities of the portion of the fund increased significantly, and you can see that in the NAV. But if you compare that with the Nifty 500 Value 50 Total Return Index, the benchmark of the fund is actually Nifty 500 Value 50 Total Returns Index, then you can see that the benchmark has outperformed since inception, but that's because value has turned itself around. It's the value cycle has changed after the market crash. The value investing has gained momentum, and that's why the benchmark has gained momentum. Nifty 500 Value 50 benchmark is extremely volatile benchmark. I've shown that in the past in several other videos. I think I may have a picture here. Let me see. The point is only not just this fund has underperformed the benchmark. Quantum Long-Term Equity has also underperformed the Nifty 500 Value 20 benchmark. So has ICICI Value Discovery. So there's nothing particularly wrong about this fund, but it's just too young and untested as far as we know, because it just has about 7-8 months of existence and so on. So the problem with choosing Nifty 500 Value 50 as the benchmark is, when the going is bad, it will be very easy to beat that benchmark. When value investing is not performing at all, it will be very easy to beat that benchmark. But when value investing is performing, as we have seen, then it will be hard. Then it could be hard to beat that benchmark. But the funds will be less volatile than the benchmark, because the benchmark itself is extremely volatile. The value investing benchmark, if you can see here, these are 5-year rolling returns of the Nifty 500 Value 50 index. That is a white, and the green is the Nifty 500. You can see that the white line fluctuates a lot more. That's why I keep saying this. Value investing is a lot more volatile and risky. Many people don't seem to appreciate this. All they do is quote Charlie Munger and Warren Buffett and so on. They don't understand that value investing is inherently risky. But well, what do you know? So that's the problem with this fund. There's nothing wrong with the fund. It's an interesting fund. It's an interesting fund to track and so on. You can even invest in it, but you must be ready to face those long periods of underperformance. So this is the overseas investment that's in orange. So you can see they have gradually started increasing the investment, and it's about 20-25% now, roughly about it. And that's where the NAV has become less volatile. Since inception, they have gradually increased it. And in terms of the market cap of the Indian stocks, you can see there's a more or less good mix between mid cap, large cap, and small cap. It's a very good mix. That's the kind of ideal mix a fund should have. But it's value oriented, so you'll have to be prepared for those periods of frustration. How do you know it's value oriented? You can see that from the price to earnings ratio of the funds. You can see the Nifty, the UTI Nifty fund. That's the benchmark. That's in yellow on the top. Then you can see the DSP fund has got a PE value much lower than that. That's the blue one. The orange is ICICI Value Discovery. Red is Parak Flexi Cap. Gray is Quantum Long-Term Equity. You can see Parak Flexi Cap is not as value oriented as it probably was in the past. Its PE is relatively higher. You can also see it in the PB ratio, the price to book value. You can see again the Parakparik fund has got a much higher PB. The DSP fund, the blue line, has got a much lower PB. So lower than index PE and lower than index PB is the hallmark of a value fund. The only catch is we must understand that the value fund, suppose the value discovery fund or a value any value oriented fund unearths a multi-bagger because they invested it when nobody was investing and then the market discovered that and the fund started zooming up. The point is they cannot hold it all the time. They may have to, because of their value oriented mandate, they may have to sell that, book the profit and push it in, buy other underperforming stocks. So you must understand that is the problem why the value oriented funds go through significant periods of poor performance. They have a mandate to remain value oriented at all times. Parak does not have that mandate. Once their stocks picks come good, they don't need to sell that to buy other value stocks. They can hold on and call themselves a growth oriented fund. They have that flexibility. So this is the problem. DSP fund, there's nothing wrong with the DSP fund. You can consider it, but you must be ready for prolonged periods of underperformance.